Well, we prepared for a volatile week, and a volatile week we got. The major events are behind us now, but there's still lots of conflicting data points to cover in today's episode. So let's build a game plan for the upcoming week and cross our fingers in the hopes that with fewer catalysts, we'll have more normal market conditions. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe for 100K by now the end of May, and stay tuned until the end of today's episode. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly time frame chart now that the April bars have officially closed out, and the illustration here is quite simple. I just want to point out that the pullback during April's monthly range, intraday, intra-week, intra-month, it was definitely volatile, but in the grand scheme of things, we haven't done anything to even come close to jeopardizing the monthly trend. The previous all-time high can act as a zone for a possible higher low on the monthly time frame chart, and even if that breaks, you can still capture a monthly higher low if we were to respect the highs of the July and August bars of 2023. So once again, if we're trying to navigate as an investor the market overall, if we're trying to gauge the sentiment of the market, is it fair to say that the bears have an overwhelming edge right now? I don't think the answer is yes. And the highest time frame pattern that we've been tracking for quite some time now is this as a monthly bull flag, possibly breaking out. What's the measured move? And the measured move is just a suggestion. It doesn't mean we have to go here, but if we're trying to navigate from a point A to a point B, let's think about this, right? So let's just round this down and call it 610 as a possible target in the upward direction. Heck, you could just call this 600 if you'd like. Let's just say that your possible entry point here was the retest of the inverted head and shoulders neckline during the pullback, and you got long sometime during October of 2023. If you're trying to move from point A to point B, all the way up here, the April pullback can't be enough to shake you out of that possible position, especially when we understand that the monthly trend is up. Lows, higher lows, easily an opportunity for higher lows as long as we're over that previous all-time high, or once again, the July and August highs of 2023. So the point is to just understand that the higher time frame context of the market is still bullish, regardless of what the headlines say or how you feel intra-week, intraday when the April pullback was taking place. So let's get more granular now on the weekly time frame chart. And as always, we'll talk about candle structure and location. What do we see in terms of structure last week? A hammer-esque style bar, right? Definitely a hammer candle there. So the opening print was violated. There was a lot of volatility in the downward direction, but clearly buyers responded in that lower wick off of the lows of the weekly range. They were able to push back to the opening print and, of course, through the opening print, giving us a green-bodied bar. The reason I like walking through that step-by-step every single time is to just illustrate that, yes, there was the presence of sellers. However, the buyers clearly overwhelmed, and the close over the opening print giving us that green-bodied bar is very important. That, to me, is a bullish takeaway in terms of structure. If we're thinking about location on the bar-to-bar count, we do have ourselves a higher low as well as a higher high. So buyers go 2 for 2 on the weekly trend count. Now, I will, of course, concede that we're still inside of the larger red-bodied bars range. If we do something like this, we have 2 inside bars on the weekly time frame chart. And we also know that we've been describing a possible threat of a weekly lower high up against the low of this bar. That number is at 512.50. That's exactly the high of last week's bar. So is that threat still credible? Is it still possible for a weekly lower high? I think the answer is absolutely, but based on the monthly trend being up, based on the weekly long lower wick that we just described in detail, based on that hammer candle, I'd like to be a little bit more optimistic here on the weeklies, looking for a move back in the upward direction. So when I'm talking about conflicting evidence in the intro of today's video, this is where we can start to see that push and pull. So we have technically closed over the 38.2. We know that we undercut it over here, which is what really opened up the idea for a lower high in the first place. If we bring out the anchored VWAPs on the weekly time frame chart, we've recaptured, and last week's low is directly supportive over the 38.2. So to me, that's a noteworthy takeaway here for our bulls. And once again, remember back to the monthly time frame chart, definitely in an uptrend, right? Let's clear that up. And I also want to show you, though, something that supports more of the bearish narrative, which is the possibility of a lower high off of a high volume node, right? What is this? This is your possible lower high off of the highest volume node at 512.50. So push and pull starts to emerge, but based on candle structure and price action itself, I'd be a little bit more optimistic here that this recapture of the 38.2, the fact that we are seeing buyers step up, we're going to look for a break of 512.50 this week possibly. So let's bring it on down now to a daily time frame chart. Let's get really granular here. We'll even check out the hourly in just a second. The first thing we want to describe on the daily is always the weekly expected move. So if you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 517.55, implying some sort of higher high, and a break of our weekly line in the sand at 512.50 for that possible lower high. We know where this is coming from. We know the previous weekly wick we just pointed out, as well as the support from back here. If there's ever a spot for a weekly lower high, it's right there. Right? The lower bound of the weekly expected move, though, also offers some push and pull. The number's at 505.04, and that technically represents a higher low, as well as, if we support here, represents a gap fill reversal directly to the high of the Thursday session. That does strike me as constructive in the upward direction. If we're trying to navigate the trend that's trying to unfold here, I think we want to talk about lows, higher lows into the end of last week, as well as a big time higher high. So the Friday from 2 weeks ago made a higher high. This Friday made a higher high. And yes, we are rejecting that daily 50 SMA, but the trend is trying to turn in the upward direction. I would also point out, in terms of push and pull, strength and weakness, the rejection of the 50 SMA doesn't strike me as big of a deal as the failure of the sellers to close the gap below us on that Friday move. It was a partial gap close. You can see the lower wick of Friday's bar. It looked into the gap, but it could not get all the way down to Thursday's high. So in theory, there's no structure in there. Why were the sellers unable to close the gap all the way? Right? The other failure from the sellers to sort of hold on to here is the nasty inverted hammer that printed on the Wednesday session after the FOMC. And as we'll see on the market profile, there was an undercut of that low of day. We made a new low on Thursday, and where did we close on Thursday? Right back up towards the highs. Now, granted, it wasn't a close on Thursday over 505.75, but pretty close, and obviously Friday is over that level now. The possibility of a gap fill reversal over 505.75 strikes me as being what the buyers really want to hold on to into this coming week's worth of trade. If we take a look at an alternate drawing set here, you can see that we've got our counter trend channel, and we've also broken the primary trend line coming from the very first volatile breakdown that we saw. Remember that this was mainly driven by geopolitical tensions, right? We know that's where the volatility came from, but it's also the top of the move. You can see a rejection off of it, rejection off of it, rejected on the Friday of 2 weeks ago, and now we have a firm close over that resistance trend line. Is it reasonable that we see a daily pullback with the small upper wick rejecting the daily 50 SMA, rejecting the upper bound of the counter trend channel here? I think the answer is absolutely. And once again, if we just go back on over to, we want the regular drawing set. I think the opportunity for a gap fill reversal higher low is really what the buyers want to hold on to here. I mean, clearly, if there is going to be continuation in the upward direction, that would be constructive as well. I'm not gonna look at this and say, okay, bears are in control. We're making a new higher high. I was really hoping for that higher low. Absolutely not, right? So if we can take out 512.50 anyhow, that would also be bullish. So on the daily time frame chart, there are plenty of outcomes here. Consolidation is great. Higher lows over this are great. Higher lows here also keep us bullish on the daily time frame. If things are going to change to bearish, I would really want to see a lower high underneath this level right here at 505.75, the lack of a gap fill reversal. Let's bring it on down to the hourly time frame chart now and really evaluate what's happening over here. So if we're thinking about hourly trend, I don't think it's so clear, right? The move is not really well defined. You have a little bit of up, big gap down, battles back, big move to the downside. This is just totally volatility, right? And this gap up starts to get us thinking along the lines of an uptrend, but we don't technically have a higher low yet. So if we're thinking about how we can achieve an hourly uptrend, I would definitely be thinking lows, opportunity for a higher low here. We're coming from the highest high. So if there's a pullback this week, the daily gap fill reversal thesis that we just sort of described at 505.75 is making a lot of sense here. That to me is great, right? Buyers would hold on to that. If we're also thinking about the failure of the sellers, right? This, as a head and shoulders, was unable to produce a lower high here for that right shoulder never mind even test or break down through the neckline at 499.75. So the fact that that's also not taking place strikes me as a little bit more of a bullish data point here. If we're bringing out some supporting evidence via the anchored VWAPs intraday, you'll notice that we've recaptured the entirety of the band. So here's a bunch of volatility during the FOMC. This anchored VWAP goes all the way back to the geopolitical day way back here. We are now over that as a level. So once again, on the daily chart, when I was describing consolidation, a possible break that looks like this, I mean, be my guest to scalp back and forth in the hourly range here, but supporting over that anchored VWAP is constructive in the upward direction for the hourly trend to remain up. Let's come out with a couple of Fibonacci's as well. The first one from the lows up to the highs. And what you'll notice is that the 38.2 is beautifully there at the gap fill reversal, giving us super support basically at 505.75. That is constructive. And if we come in with the fibs now from the top of the breakdown, the major breakdown where the daily trend changed, right, all the way down to the low, how much of this have we retraced, right? We are back over the 61.8. This is kind of in no man's land in between the gap range right here. So I wouldn't lean on that too much. I would be thinking more about the gap structure under 508.65, closes at 505.75. But generally speaking, the more time we spend over a 61.8, the higher the likelihood of a 100% retracement, and that 100% retracement is suggestive of a recapture of the weekly line in the sand at 512.50. So everything that I can see so far wants to remain optimistic, but I don't think we're out of the woods yet until we either have two things. Number one would be the higher low and an equal high reattempt here at 512.50, right? The weekly lower high needs to be respected as a possible threat still based on the volume profile we just talked about. Again, I'd like to be optimistic, but it's still on the chart. It's something that we have to contend with. It would still represent as well a rejection of the 50 SMA on the daily if we back away from this aggressively and start making new lows. So in terms of pathing, what we can directly look at here for the S&P on the hourly, consolidation is bullish. I would lean on this as an outcome this week. If we break here, you could scalp this for the gap close. Then I would be highly attentive to the reversal via some sort of double bottom, inverted head and shoulders, or just a very simple hourly hammer candle down here off of 505.75, taking us back in the upward direction for a daily higher low. The time where the bears really come out to play and say, hey, we're swinging it right back in the downward direction is on a lower high underneath 505.75. If this is achieved right here, I would change my tone to being slightly less optimistic and more bearish. The alternate opportunity for the bulls, obviously, is just a straight up break in the upward direction. If that were to take place, ideally a higher low is still offered over 512.50 to negate the opportunity of a weekly lower high underneath. That's what we've got out of the spiders on the hourly. Let's quickly take a look at the market internals. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This is always supporting evidence Exhibit A. Market internals here show us that on Thursday, as we were battling off of the low from the Wednesday FOMC, we did have substantial volume inflows. You'll also see on Friday, we had volume inflows as well. That'll be important because we did pull back for a partial gap close, right? Look at what happened on Thursday here with the index score. I want to get really granular for a moment and actually show you on a 5-minute time frame ES this inflection point right here. We've been talking about 50.85 for forever, right? And notice that the index score is strongly positive into the afternoon on Thursday when the ES is finding a higher low over 50.85. That does strike me as a bullish flip, noting that during the FOMC breakdown, if we take a look over here, there's your lower high underneath 50.85 on Wednesday when the index score is basically flat or on its way down from the volatility that we experienced over here. So it does strike me as a bullish flip out of that particular takeaway. In terms of the advanced decline line itself, positive reaching back to trend higher zone on Thursday, positive not quite in trend higher zone on Friday. If we think about the cumulative build out of the tick, strong reads on Thursday building throughout the day, so this was not just a short squeeze. Let's go back to a zoomed chart here. So we can talk about the move on Thursday, right? This respectable at the exchange level with a steady build all day. Friday, a little bit of reservations, right? Not really a strong showing, but not the end of the world either, noting once again, partial gap close and then closed up towards the highs of that individual session. Let's move on over to the market profile now because there's also a pretty big takeaway over on the market profile. If you're not familiar with the market profile, check out the video tutorial in the top right-hand corner. This is always supporting evidence Exhibit B. And the main focus is what we started to describe with the lower low that was produced on Thursday, repairing the poor low from Wednesday, right? So this was the improper end of the auction on the Wednesday session. You can see 4 TPOs flat across the bottom. Even if you zoom in, I think you start to see lack of material excess, so still 2 TPOs flat across the bottom. But look at how we undercut this with single prints in B period on Thursday. That repairs the poor low. And where did the B periods stop? Let me scrunch this chart out just a hair here. What is this? This is the VPOC, Virgin Point of Control, that we described in the Wednesday midweek market update. So this repairs, and basically you could use a baseball analogy. It, quote, tags up to the previous base, repairs the naked point of control, right, Virgin Point of Control, then rotates in the upward direction. Intraday, if I split this profile, we're getting really into it this week, right? We're really diving in today. Look at where the higher lows were found. Higher lows then found over the point of control from Wednesday. That, of course, is noteworthy. So overall, when I'm looking at the market profile and what happened last week, the reaction off of the lows starts to make some sense here. As we think about what happened on Friday, the main takeaway here is that the value area and point of control are both over the Tuesday high of day. So do we have stronger sellers in this market? At this point, I would have thought that the gap would have closed more. Value area and point of control would have been lower on Friday, but the fact that it's over the Tuesday high of day once again leaves me feeling more optimistic about the market instead of pessimistic. Let's change gears and take a look at the QQQ NASDAQ 100 on the monthly time frame chart. Once again, the candle in question is the second one in the larger red-bodied bar. How did the April pullback fare compared to the previous all-time high? A little bit closer than what we had in the S&P 500, but undoubtedly still an opportunity for lows, higher lows, and the offering of a monthly higher low. We're, of course, pulling back from the highest high, the all-time high, in the trend count, so therefore, the trend remains intact in the upward direction. Optimism starts to come to mind. Just as a general reminder, if we're thinking about what's required for a larger deterioration out of the market, great example back here in 2022, you really need higher time frame lower highs and higher time frame lower lows. When this happens, we would not have an optimistic take on the market. As of right now, we have the exact opposite, sitting in a glaring monthly uptrend. Unfortunately, unlike the S&P 500, this is not a monthly bull flag because the retracement was too deep. We went all the way down to a 61.8 Fibonacci retracement instead of respecting the 38.2 or the 50%. So no bull flag. However, this is still very much so a cup and handle, and we have not achieved the measured move target yet. So using a similar illustration to what we did in the S&Ps, coming from the base of the cup to the handle low, what do we see for a measured move? We're talking about loosely, let's just call it 475. So the illustration still stands, the concept still applies, that if you're trying to navigate from a point A, the pullback low, or a point A breakout point on the monthly chart, to a point B target up here, April's pullback should not be enough to really have you overly concerned about that possible position. If you just get shaken out based on these little pullbacks, you'll never be able to navigate the move from point A to point B and capture a larger return in something like an investment account or a swing trade account. As of right now, bulls remain in complete control of the higher time frame monthly. Let's drop it on down to the weekly out of the QQQ NASDAQ 100. A lot of overlap here in terms of candle structure and location, just like the S&P 500, so I won't bore you again with all of the details. But a hammer-esque style bar, buyers obviously responded, closed up near the highs structurally. Buyers are in control. On the bar-to-bar count, we do have that higher low as well as higher high, yet still contained inside of the larger red-bodied bar range. So technically speaking, buyers go 2 for 2, but still maybe a little bit more neutral. One of the things that does need to be pointed out here is the close over the bottom of the 7-week balance range, right? So the fact that we have closed over 433.75, and we'll see this on the daily chart in just a moment, once again brings me back to the word of today's episode, which so far is optimism. This close does not guarantee that a new all-time high needs to be around the corner. If there's a daily breakdown and a lower high underneath, absolutely, you have highs, lower highs possible still on the weekly time frame chart, but if we're thinking about the data points in hand, the close over that level is substantial and does side more so with the bullish nature of the market move so far. If we come out with some Fibonacci's from the low over here to the all-time high, all of this is taking place over the 38.2, over the top of this balance range here. Even if you come in from the January pullback to the all-time high, we did respect the 61.8 Fibonacci, which is always a line in the sand, correct? We'll bring out the anchored VWAPs on the weekly time frame chart as well. We've supported over this. We've closed more firmly over the January pullback anchored VWAP. Also, this does strike me as, again, more optimistic for a move in the upward direction. We do still have the counterpoint, which is the volume profile here as well on the weekly, possibly acting as an area of resistance. So we'll try to balance the analysis. We'll show you all the data points for what they're worth. It is possible that this high volume node acts as resistance, but once again, the longer lower wick, the closure inside of the weekly balance range, optimism comes to mind. Let's drop it on down to a daily time frame chart here, QQQ weekly expected move. What do we see out of the numbers here? We've got 442.68 on the upside, implying a higher high. And on the downside, we've got 428.29, implying a higher low, and also not even a full closure of the gap, but if we support around that area, the opportunity for a gap fill reversal, right? That is bullish, just like the S&P 500. The trend here is trying to be in the upward direction, and once again, I think the most notable highlight for the QQQ NASDAQ is the move up and over the weekly line in the sand here at 433.75. That closure is very, very impressive. Now again, we do still have a opportunity for a rejection off of the daily 50 SMA. Are we out of the woods? I don't think we're all the way out of the woods, but these are really strong first steps in the upward direction. Just like the S&P, if we had stronger sellers, why were they not able to materialize on the inverted hammer from Wednesday? Why were they unable to close the gap on the Friday morning move in the upward direction, right? So buyers seemingly are building a stronger edge here on the daily time frame chart. We can show you the alternate set as well. Here is our counter trend channel. Is it possible that we see some pullback off of this level? Absolutely. And ideally, we would want to see the lows of that Friday session supported for consolidation. Then the target would be what? I mean, from a trendline perspective, you would want the resistance trendline. We have not broken that yet, whereas the S&Ps did. The S&P was much steeper, something that perhaps looked like this, right? But regardless, that would be a possible upside target or the origin of the breakdown, which is here. If we just quickly flip back to the other drawing set, that would be the upper edge of this week's expected move at 442. So daily game plan. If you want to remain neutral, fine. Keep an open mind in here. Has to be bullish on the recapture of 437, targeting the origin of the breakdown. If we break down here, there are definitely scalps that can unfold, but looking for a daily higher low, lows, higher lows. Remember, we're coming from the highest high now in the trend count over 427.25. I would have to change my tone if we broke down underneath that and traded for some sort of equal low or offered a lower high underneath. That would certainly start to feel much more like a weekly lower high rejection of the bottom end of the 7-week balance range. Let's continue to get granular here on the hourly time frame chart out of the NASDAQ. The higher time frame pattern that's potentially in play is this as a double bottom. You want to see price acceptance over the Tuesday and Monday highs of last week, over that weekly line in the sand. Another failure from our sellers to reinforce the bullish nature of the pattern is that the lower high for a right shoulder on the hourly chart to produce a head and shoulders, just like the S&Ps, simply did not take place. If we take a look at our anchored VWAPs, of course, a lot of this will be very similar to the S&P or over all of the anchored VWAPs. If we come in here with a couple of Fibonacci's coming from the low up to the high of what we got there, the 38.2 is your gap fill reversal. Once again, 427.25. And if we come in from the origin of the breakdown all the way to the low, obviously we are well above the 61.8. There is a structural level here at 430.50. 430.50 is the low of this move here. It's where we started to see some support, broke down lower high, FOMC lower high as well. So the 61.8 is reasonable based on structure, anchored VWAP as well as Fibonacci. However, it is inside of a gap range, so I wouldn't take out a second mortgage on the house looking for that to act as a solid area of support. I wouldn't be surprised if it acted as support, but I wouldn't really make an overwhelming bet on it. I would really look for the better structure here on the gap close. So what does that leave us with in terms of pathing for the NASDAQ? Of course, just like the S&P, consolidation, break, higher low, hourly uptrend, right? There's your higher low, higher high, beautiful, good to go. If we break down, once again, scalps are available. We're willing to trade this in the downward direction here, but do not overstay your welcome. We're still thinking about double bottom. We're thinking about inverted head and shoulders. We're thinking about hourly hammer candle as a reversal off of 427.50 for a daily higher low. Correct? The time where we change our tone to being definitively more bearish is on a breakdown here, lower high underneath, trades to the equal low, looking for this to flush, trades to the equal low on the weekly. Now we're in a weekly downtrend with a weekly lower high. As of right now, once again, trying to remain a little bit more optimistic based on the market's performance on Friday, holding the majority of the large gap up from the non-farm payroll report. Let's take a brief glance over at the market internals for the NASDAQ. A lot of the same commentary over here, so we'll keep it brief. Strong volume inflows on Thursday and Friday, even as we're consolidating here on the gap up. The advanced decline line is definitely positive, a little bit stronger on Friday, holding near trend higher zone. A little bit of a concern on the Friday flat read out of the cumulative build, but certainly on Thursday ramping throughout the duration of the day when this trend intraday was actually taking place. So very solid implications for the move back in the upward direction. It's not like it's happening on no volume commitment. It's not like the advanced decliner is counter to the move. Only concern here is the lack of participation at the exchange level on the Friday session. But at that, right, would I call this bearish? Would I be short based on the Friday activity and say like, oh no, this is massively divergent? I wouldn't really call it that. You really just had a compressed tick out of the NASDAQ on that Friday session, which is why the cumulative read couldn't really get off the ground. Let's take a brief glance over at the market profile for the NASDAQ, and you can see a lot of the same indications as the S&P. We repaired the poor low, put in decent excess and B period. The value area is climbing in the upward direction here and here, and on Friday, the value area and point of control is also over the high of that Tuesday session. So as all of these things come together, the NASDAQ specifically as a backing force for the S&P, optimism, as I butcher the sort of highlight and the main sticking point, optimism is the word that is at the forefront of today's analysis. Let's change gears one final time to the IWM Russell 2000 small caps on a monthly time frame chart. The bar in question, of course, is the larger red-bodied bar for April. What do we see here? At first glance, this is an oh my goodness, check out the failed monthly breakout, check out the closure back down inside of the monthly balance range. And while both of those statements are technically true, I remain, here's the kicker, optimistic. Now, let's disregard the close back above this week for the early stages of the May bar. We'll get to that on the weekly chart in just a second. Let's take a 90,000 foot approach, right? In this segment of the balance range here, it was 2 bars down, 2 bars up, 1 bar down, 1 bar up, so on and so forth. We were not making any progress. The market was not trending out of small caps. Now, I'll be the first one to raise my hand and say, yeah, no kidding. Of course, the IWM uptrend that's budding is nowhere close to as strong as the S&P or the NASDAQ. However, all trends have to start somewhere, do they not, right? And is it possible that on the monthly chart, we're starting to see some progress via some sort of major higher low? Is it not also reasonable to call this for what it is, which is technically a monthly higher high? It looks constructive to me, and it looks like a change in tone from a market that was clearly indecisive inside of this balance range back here. A couple of Fibonacci perspectives also agree. If we come in from the low of the sickness move up to the all-time high, we're more firmly over the 38.2 with price acceptance taking place there. If we come in with the fibs from the low of the move here up to the most recent high, we're respecting the 38.2. This one should not be a surprise. We've checked in on this on the weekly charts for a number of weeks now. But we can also come in from the all-time high to the low of the balance range here, and we're supporting over the 38.2, which is negating the opportunity for more of a bearish take on the monthly time frame as a bear flag. You'll also clearly see that we're over the monthly 50 SMA. So I remain constructive on the higher time frame charts for that reason. If we take a look now at the weekly time frame chart, the biggest information to describe over here is just the close over 200. The big weekly inflection point that we've been monitoring for a number of weeks now has been recaptured. And the reason that this is so important is because if we come in here with a Fibonacci from the high of the move down to the low of the move, the 38.2 was keeping us contained on the inside bar of the range from 2 weeks ago. If we had closed at the lows of last week's range, it would have kept bear flag consolidation alive, and the threat would have been really apparent for some sort of head and shoulders here to break down underneath this zone. And what would that have done? On the monthly chart, it would have brought in a lower low, or at least the higher low opportunity would not nearly have been as clean. So for that reason, things are looking okay and optimistic here on the weekly, on the monthly. We're trying to navigate the trend reversal back in the upward direction. Let's go out to a 5-year chart here so I can bring out some of the anchored VWAPs on the higher time frame. And if we zoom in, notice that the cluster is still supportive of the monthly higher low thesis that we just outlined. So on the weekly charts, as long as we're over 200, on the daily charts even, as long as we're over 200, things are looking pretty good for the beginnings or the early stages of a more concrete monthly breakout, confirming the monthly breakout, or at least, worst case scenario, just avoiding the breakdown back to the bottom end of the range. Let's check in with our volume profile. This is also looking constructive. Notice that we've cleared and we've closed over the highest volume node. We're in the low volume void. The argument is not that we're instantly going to travel up to like 225, but there's less of a chance for overhead supply here to weigh on markets in the downward direction. If you are trying to be pessimistic out of the IWM, be patient and wait for a breakdown underneath loosely 190 as the neckline of your head and shoulders. If that takes place, sure, we'll target the bottom end of the range, but as of right now, we simply do not have the supporting evidence to make that a reality. We can keep it really brief on the daily time frame chart. There's no need to overcomplicate this chart. We broke out over the weekly inflection point, big gap up on Friday. The gap started to fade. It did not close all the way. A gap fill reversal is incredibly constructive. Gap fill reversal at 200 over 199, looking good. It's also a short-term uptrend. Lows, higher lows, higher lows. We have highs. This gap up on Friday is instantly a higher high. We actually were able to gap up and over the 50 SMA on the daily time frame chart, unlike what we saw out of the S&P and the NASDAQ. So that is also another small constructive data point. We're not cleanly rejecting underneath it. It could have been more bearish, basically, is the takeaway there. And I'll just leave you with a couple of the levels here. The upper edge of the weekly expected move is 205.71. The bottom end is at 198.09. You could call it 198 flat even. That would still technically be a higher low from this area to this area. Ideally, though, it's just support over the 200 to 199 zone, looking for a higher low in this area right here. Let's take it on down to the hourly chart once again. No need to overcomplicate this. We could get a little bit forensic and just point out that these are much more so equal highs, whereas the S&P and the NASDAQ clearly had the offering of a lower high on that FOMC rejection for a possible head and shoulders. Not the case over here in small caps, once again, acting as more of a bullish data point and a bullish takeaway here. Bear flag on the Friday session, so if this is going to get some breakdown, again, not unreasonable to see this gap fill. It's all about finding buyers in this 200 to 199 area as a possible zone. If we come in with the anchored view apps intraday, we're above the cluster. The cluster slowly over time will creep up towards this 199-200 zone. That, of course, is constructive. And then we'll finish it up with a couple of Fibonacci's here, market internals, and then the profile. So coming from the lows up to the highs, would you look at that? Your 38.2 is right here in the higher low zone, around 199 currently. And also, this has retraced 100% of the drawdown from the April 12th move. April 12th is really when these breakdowns took place. Obviously, we're over that based on the gap up from Friday. Not the case over here in the QQQ NASDAQ. Here's your April 12th. Here's the current trade price. And same thing over in the S&P. So just pointing out, on a relative basis compared to where these breakdowns began from, small caps have already recaptured that area, right? So that is noteworthy. Let's bring it on down to the internals for the Russell. You can see inflows on Thursday and Friday, even as we're going sideways here. This is noteworthy. It's bullish consolidation there. Sure, you could technically get bear flag breakdown, but is it like we have stronger sellers entering the market? The answer is no out of small caps. Same thing here in the advanced decline line on Friday. Really weak tick cumulatively on the Friday session, but again, no surprise there. At least it's not negative at the exchange level. People were not selling it aggressively, even though we saw this breakdown and just consolidation into the afternoon. If we take a look at the market profile over out of the Russell futures, again, here's your value area and point of control lower in the individual session from Friday. No surprises, obviously, but if that means we have slightly more bearish acceptance there, a break to repair the poor low from the Friday session is not unreasonable to close the gap. On your Russell futures, we're talking about loosely around 2030 as an area. Generally speaking, progress is being made from the lows. We have value area here, and value area did technically progress on the Friday session. All right, let's give our unhinged optimism a bit of a reality check here, beginning with the weekly performance of the S&P sectors. The utility sector is up 2.64%, leading the pack on the week, and this is a concern. Why? Because we're trying to spot a daily trend reversal. We're trying to build more confidence in the new formed uptrend, and as we know, utilities are lightweight and they're deferred defensive. This seems more like a risk-off rotation. Underneath is the XLRE real estate, another incredibly lightweight sector for the S&Ps. We'll give some credit where credit is due. The XLK tech sector, the heaviest weight risk-on sector for the market, is up 84 basis points on the week. However, as we'll see on the structural charts in just a moment, there's a huge red flag there. The energy sector is down over 3% at the bottom end of the barrel. Then it's discretionary down 90 basis points and financials down 64 basis points. Both of these sectors are heavier weight risk on sectors, once again reinforcing the idea that posture is not stellar here. Let's take a look at the structural elements. The XLU utilities chart is sitting on the highest high, offering a higher low pullback over the breakout point at 67. Means that the trend is constructive, but as we know, this reinforces the risk off look for the market. Here's the real estate sector. What do we see over here? Not much. I would be more constructive for bullish pressure if we could recapture the weekly double top neckline at 3770. As of right now, neutral through here. As we know in lightweight sectors, if we make a new swing low, that's where the bearish pressure resumes. Next up, we've got the XLK. This is where the huge red flag is. Anything that you notice about this chart relative to the QQQ should be jumping off the page at you. We have not recaptured the weekly inflection point. So 203.90 is still a huge threat for a massive lower high, keeping all of this as overhead supply. This week, huge sigh of relief. If we can break and higher low above, awesome. Constructive risk on appears to be coming back into sights for the market. If we remain consolidating down here, I have to call it for what it is. Still the opportunity of a weekly lower high. If we break down to start closing the gap, of course, intra-week, that is bearish pressure for the S&Ps. A gap fill reversal is required if you're trying to maintain a more optimistic stance for your S&Ps. We have lows, higher lows, maybe higher lows if it holds. Anything outside of that higher low starts to feel much more like just bearish consolidation underneath the weekly inflection point. Next up, we've got communications. I would feel more confident about communications if we could get price acceptance over 80. As of right now, it seems like a very sloppy and volatile downtrend with the offering of highs, lower highs, and still lower highs, rejecting the daily 50 SMA. So 80 is your inflection point here. Next up, the healthcare sector is stuck in a balance range. It's trying to be constructive for possibly a break of this as an ascending triangle. You have these very minor higher lows that are building out. Friday's an inside bar. If you can crack the equal highs, looking for the rotation into 143.20. What's the issue? Third heaviest weight sector by market cap. Clearly, the offering of a weekly lower high, reject the daily 50 SMA. You're not out of the woods yet. So we still have concerns when it comes to our S&P sectors. Here's the XLP, consumer staples. This is D for defensive. It's also lightweight. What do you notice about the trend? It's more clearly trading near these equal highs. You could call this a pie in the sky inverted head and shoulders. You could call this a bull flag, however you want to classify it. If you break out over 76.25, it once again reinforces more of the risk off rotation. What about the SMH semiconductor? Still the offering of a lower high. Highs, lower highs, lower highs, rejecting the 50 SMA. Now, we'll give credit where credit is due. Is it possible that we're building out a higher low double bottom? Could this turn into an ascending triangle, get really tight here and then break in the upward direction? Absolutely. Maybe NVIDIA earnings are going to be a catalyst for that. But as of right now, if we are underneath 219.70, can't really say anything overly constructive. I would be neutral through here because of the higher low. And once again, we've talked about this 212 area, right? At first, the first loss of it over here, okay, great, lower high underneath. When we lost it again, another bearish indication for the market. Now that we've recaptured on Friday, I would have to maintain a neutral stance through here, bullish pressure over 219.70 underneath this low for a lower low, just trading into the equal lows. Obviously, that's bearish pressure for your S&P 500. Energy sector is breaking down aggressively into the 50 SMA. Notice the longer lower wicks, but closure back above the 50 SMA on the Friday session. Would not be surprised at all to see a counter trend to possibly retest the breakout point here at 94.25. I'd be more concerned when and if this yields a lower high and makes a lower low. So underneath 92, not great for your market. Next up, we've got the XLY. This is a heavier weight risk on style sector. This is worth talking about. Double top is still in force. There's your neckline. Tried to recapture, still pretty sloppy up here. This move, if it's going to stick, needs to offer a higher. I basically need to see consolidation here. Right? It's got to be over this 177.75 neckline of the double top. If you get consolidation here, fine, neutral, constructive, lows, higher lows. Otherwise, what do you see from a weekly perspective? Is this not just a massive, there it is, man ray pattern, right? Underneath the neckline here, danger, look out below. So Amazon, it's helping, it's higher, but it's volatile. Tesla, it's trying to help, it's trying to make a move in the upward direction, but we're not out of the woods yet, out of consumer discretionary. So trying, again, keeping an open mind, 177.75, but if we slip it, it's got to be more bearish pressure. So again, we're trying to dial back some of that optimism and be realists based on the sector performance. XLF financials, again, being a realist, where is this lower high? It's underneath the neckline of the head and shoulders, which caused the reversal in the first place. Anything constructive here? Some lower wicks, but I mean, still underneath the 50 SMA as of Friday's close. Breaking down underneath this 40.45, I would just be looking for equal lows, right? And then you have yourself a classic H pattern on the weekly, break through these equal lows, and it continues in the downward direction. So we're not out of the woods here. Although the price action seemingly is really looking great, it's not sector-wise really in the clear yet. Let's go to the XLB really briefly. Volatile inside of range, upward pressure over 90.30, downward pressure underneath the lows of this area here. What do we have? Loosely 87.90s. Next up, we have the XLI, industrials, classic head and shoulders. You could put that into textbook, but notice that we're opening near the highs of the right shoulder. I would be optimistic for a pop here, and that might be some upward pressure. But again, let's think about the order of magnitude and operations here. Whatever the XLK does, likely the S&P is going to follow. So if the XLK decides to close the gap, even if XLI is doing this, probably not going to see a strong day in the S&P 500, right? Let's check in on the ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This is still a red flag underneath its downward sloping now 50 SMA. Sure, you've got the opportunity for a double bottom, but offer a lower high here and we remain risk off. This is, I would say neutral for the market, remembering that the XLV is risk off in the first place. It's still technically higher than these lows over here. The XLF does not look great. Underneath, it's now flattened out 50 SMA, so this is not constructive to remain in a risk-on look. And the XLY is clearly offering the possibility of a lower high at the 50 SMA. This looks like a risk-off rotation. This looks like a risk-off rotation. This is pretty neutral out of industrials, and communications are even lagging for a possible lower high. Again, this is truly trying to dial back some of the optimism here by taking a look at the relative performance and the market's appetite for risk, really. XLK SHY, lower high opportunity. If this remains underneath 2.5, risk off rotation. Let's move along to apples, XLK XLU. Breaking down, even if it goes for a counter trend, lower high is available up against that 50 SMA, not great for the bulls. If we take a look at the XLY XLP, broken down from this as a range, it really never resolved this prior range firmly in the upward direction. So if this continues to stay underneath 238, again, risk off for the market. Let's move into the SMH XLV. This is the outlier. What do we see? It's actually recaptured. And obviously that's due to some of the strength out of the semiconductors and the fact that the XLV remains sideways in its overall range. It's not really doing anything impressive. If this makes a new swing high, that's where I would take note. If it's just consolidating in here, fine. It's one minor bullish data point speaking to maybe risk on. If it makes a new swing high, that's where you really have to pay attention and say, okay, why is the S&P not necessarily over its weekly inflection point? All right, so watching that like a hawk. Let's move into the dollar and see what's going on with the dollar. The dollar broke down on Friday on the heels of that, technically worse than expected labor report. The jobs added to the economy was not too good in terms of the expectation. However, look at what's happening here. Is there an opportunity for support on the retest of this previous resistance at 104.85? Absolutely. If we find buyers here and then go back into the flag consolidation, that would be downward pressure for your market. So if you're trying to look for an excuse to be bearish, look at your dollar, and if this rebounds early next week, I would say, okay, maybe the offering of a weekly lower high out of the S&P is unable to clear that 512.50. Let's take a look at interest rates here, what's going on with the TNX. This also rolled over, no surprise here, based on the labor report from Friday. We'll take a look at that in just a moment. So rates coming down should in theory be bullish for the market, but once again, is there the possibility of a break, retest, higher low find buyers here, rotate back higher? I think the answer is yes, especially based on some of Jerome Powell's commentary. I mean, here's the inverted ZT. We'll take a look at the tracker tool in just a second. It broke down a little bit, but you have to keep in mind, I think Jerome Powell is going to be more stubborn than the market maybe expects for higher for longer. I think it's really going to require the labor market deteriorating much further if Powell is going to respond to it with a rate cut, right? We know that inflation is being stubborn. So let's take a look at the tracker tool now. So notice that the market clearly responded to Friday's jobs report. Prior to that, we were really only expecting a possible cut in the December timeframe for 2024, but we've bumped it all the way back out to September of 2024. So again, it's not to say that this tracker tool is going to be directly correct, but it's to really gauge the perception of the market. And right now, the market's optimistic of a possible rate cut sooner rather than later based on the labor report from Friday. As you can see right here, the 175,000 jobs added was nowhere near the expectation of 238,000 jobs added. Now, one of the things to keep in mind is that 175,000 is still not a bad read. The unemployment rate is still historically low here. Although, yes, there was a minor uptick to 3.9, the continuing claims have not really gone down, right? It's not like we're at a stage where, oh my goodness, the economy is breaking and Powell is going to respond. It would really require probably about a 4.5, maybe something closer to 4.75 out of the unemployment rate before you're going to expect Powell to come in and actually cut rates. And his hope, I'm sure, in the back of his mind, is that the following CPI reads, and just FYI, this is the this upcoming week. We've got a pretty quiet week. We've got a lot of Fed speak, but not really anything majorly impactful. You'll notice that we have the 10-year bond going off on Wednesday at 101. Unemployment claims, as always, initial claims are expected to come in fairly light and in line with the usual. We get the 30-year bond on Thursday at 101, and then on Friday, 10 a.m., it's the consumer sentiment. But anyways, the following week after that, so not this week, but the week after that, it's right back to inflation data here with CPI. And Powell's main hope, I could imagine at this point, is that inflation starts to move in the downward direction, and he can cut rates responsibly because inflation is migrating lower and save the labor market at the same time. That would be his soft landing. Oh my goodness, it's a bed of flowers. Just land that plane nice and gently. That is his best case scenario. So we'll see how those numbers come out next week, or excuse me, the week following that. If we take a look at some of the more broken down information from the fundamental side of things, the NFP, you can see, is the first major downtick here. You'll notice that the 3-month rolling trend was actually up. This is not the 3-month rolling trend in white, but if you were to average that, we were in an uptrend, adding jobs aggressively to the economy. This reading certainly reversed that back in the downward direction. If you take a look at this here in white actually shows permanent job losers. And one of the things you'll notice is that once the cat's out of the bag, it typically leads to that deep, dark, dirty R word, recession. We'll keep an eye on it. Notice that the rate of change has been positive for quite some time now. Look at all of the times where you're in between the big, dirty R words, recession, right? You're either drifting in the downward direction or negative. It doesn't really take long before this thing gets out of hand. Again, a little bit cherry-picked, a little bit doom and gloom. I don't think we're necessarily headed for that path, but it's something to at least consider. What do we see out of the ISM Services PMI on Friday? This was at the 10 o'clock time frame. This is interesting because what it suggests is that prices paid, so prices paid is this one over here, new orders basically in white. Prices paid are positive. The actual print goes negative. Technically, this is expansion contraction at 50. So prices paid positive, employment, that's this one over here in orange, negative. You could see a hit to the labor market without actually seeing services inflation substantially decrease. So PMI is an interesting note when it's actually broken down into multiple of its components. Let's take a look at some earnings information. This is interesting. The first time in a very long time, people are starting to forecast positive growth so adjustments to EPS expectations is positive in the first month of the quarter. That's the main takeaway here. And you'll notice I've highlighted that this is when the Fed gave us liftoff and started raising interest rates. So the market's, again, expectation is that rates will be coming down multiple times, probably 2 times. That's the market's expectation right now in 2024. And I'm just not convinced that we see that, especially if CPI comes in hot again for the April read in May here. Let's move along because this is also broken down by sector. Notice where all of the revisions remain positive. It's the energy sector accounting for 8.6% revisions in the upward direction, right? If you take a look at where information technology is, aka the XLK, the heaviest weight risk on sector, they're negative revisions to infotech. So, are we out of the woods? I don't think so. I think financials generally, again, will stand to make more money as financing becomes easier, as more deal making is done on Wall Street. So that makes sense to me. That's our heavier weight risk on sector. Discretionary may be important here. But generally speaking, it doesn't sit well with me. And again, if we take a look at some of the reports that have come out so far through the earnings cycle, look at the guidance going forward. I mean, we've got 19 guiding negative and 11 guiding positive. So there's this inversion between how folks are seeing the future, between the market's expectation of rate cuts and what that means versus the actual guidance from the companies and how analysts are reviewing things on the actual underlyings, which were the 2 slides prior. If we take a look at earnings this week, Palantir is reporting, honorable mention there, Monday after the close. Lucid, if you're into the whole EV thing, people are freaking out about Celsius, maybe an honorable mention. More so Datadog, I would be interested in, as well as Disney before the open on Tuesday after the close. Rivian, again, the EV thing. That's really it. Maybe Oxy from a fundamental and energy perspective. ARM, definitely going to be influential over the chip space on Wednesday after the close. Get your popcorn out for Robinhood and AMC over here. The trade desk will be an interesting mover as well. So those are my honorable mentions. Things really slow down into the end of the week. Not really focused on anything else here. Let's move on over to the platform once again and take a look at some of the market's appetite for risk. The TLT ratio to the S&P, it's basically useless at this point. We say the same thing on it over and over and over again. This is much more more informational. So bonds in relationship to themselves, as the market's perceiving that more rate cuts are around the corner, this backing off would be indicative to me that people have tried to capture short-term rates and are now looking back to possibly entering equities. So if these continue in downtrends, or if they drift into new downtrends, I should say, by breaking 50 SMAs, by making lower highs, that would be constructive for risk appetite returning to the market. We're just not there yet. There's still the offering of a higher low at every single one of these 50 SMAs. If they catch and find support, probably an issue for the market down below. What if we take a look at credit spreads? This is constructive. This is more bullish. Notice that credit spreads in the short term here, SHY, HYG, are rotating in the downward direction. That is helpful for the market moving higher. There's a risk on indication. Let's take a look at the HYG in isolation. This has also recaptured a notable area here at 76.60, the bottom end of the previous overhead supply. We broke down, we rejected it a couple of times over here. So for that reason, I would be optimistic in the S&P if the HYG finds support and a higher low over 76.60. If we break back down underneath and are rejecting back down towards these equal lows, obviously, even if the S&P is trying to move in the upward direction, that is a massive red flag as a bearish divergence. Let's take a look at Bitcoin, what's going on with the digital gold moving back into the flag consolidation. That's slightly more risk on compared to risk off. Here's the new highs versus lows getting positive. So once again, trying to balance the data points between how the actual sectors are performing and the underlying breadth of the market. This is constructive. This is still kind of a risk-off rotation. So push and pull is totally out there as we're trying to navigate the turn. Once again, I lean back on that term optimism. The sectors don't look great, but a lot of the other supporting evidence, it's working in the right direction. What about the SPX A50R? This is the wrong direction, unfortunately, with the lower high underneath the 50% mark. If we take a look at the RSP, one of the interesting things about this chart is that it did not make a lower low towards this area, so we're all good from the equal weight perspective. I would be interested in knowing whether or not this can make a higher high. Remember that the S&P did make a higher high here in the weighted, the RSP did not. And speaking of things that are divergent, let's take a look at the QQQE, because this is a big red flag, kind of similar to what we talked about in the XLK, right? If you think about this as an inflection point, why did the equal weight not recapture the weekly inflection point compared to the weighted, which is over the inflection point? So if this is telling the truth here in the equal weight and this backs off to close the gap, it's consolidating down here, I'd be skeptical about what the NASDAQ is doing and more so align with some of that XLK information and discussion that we were just having a moment ago. The Dow is not really worth talking about. Let's move on over to the VIX, crushing underneath 15 on Friday. VIX crush Friday, if you will. As long as we're underneath 15, this is feeling much more comfortable for the market. It's one of the reasons, perhaps, why the market rallied in the upward direction. The Fed is behind us. The labor report is behind us. Earnings, for the most part, are behind us. A couple of honorable mentions as we move into the future. There, all the big heavy hitters are out of the way. So as volatility decreases, as uncertainty decreases, that technically should be bullish for the market. The VVIX, the volatility of volatility itself, is completely floored at 75 now. One of the issues here is the availability of a counter trend move, the complacency effect, as we've dubbed it, right? Not to say that this has to act as an area of support, not to say that we're just instantly going to rebound off of it, but keep your wits about you. If there's any sort of selling pressure that closes the gap below and we start drifting even lower than that, I could easily see a world in which this, reignites right back up to 103. Everybody's on edge. Technically, there's the offering of a weekly lower high. That is sort of the recipe for disaster. So if you're a bear, you really want to see the support over 75 and volatility tick right back in the upward direction. Now, with the lack of catalyst, I would really read into that as substantial. If the market organically sells off here with the lack of catalyst and the VVIX really picks up, that is a huge bearish signal and you should definitely respect it. So watching that out of the complacency effect on the VVIX. Finally, VIX futures moving into a stronger contango. So seemingly this stuff's fine, but notice what happened here out of the VIX one day. I mean, all week we were just sort of above this 1275. Only on Friday did we get a small move underneath, but there's the offering of a possible higher low still. We did not trade directly into these lows. If you're looking for volatility to completely escape the market, you want the VIX one day around the 745. We're not there yet. So keep your edge, keep your wits about you in terms of watching for any potential breakdowns. We're not in the clear. I think things are mixed at this point. We're trying to remain optimistic. I think most of the data points suggest that optimistic approach is okay, but be willing to change your mind if the data also changes. If you've made it to this point in today's episode, do me a favor and hit the thumbs up button, subscribe to the channel for 100K by the end of May, and we'll kick off the core list of companies with none other than Apple. Obviously, a huge gap up from earnings on Thursday after the close, as well as the NFP report on Friday morning, exacerbating the move in the upward direction. So Very, very simple chart. Any consolidation in here is neutral. Bulls recapture the opening print of the Friday session. Great, we'll trade into 191. If we break down, it's all about the gap closure and seeing if we can find support over 177. Do not overcomplicate this chart. Here it is on the hourly time frame. Be my guest if you want to get chopped around in here, but the game is really waiting for more structure to build out in Apple. Next up, we've got Microsoft. Let's go back out to a daily time frame chart. This thing is all over the place. It's unbelievable, but we're over 400. So we've got to remain nimble at 400. Why? Because it represents all of this as overhead supply. Thursday and Wednesday underneath was looking much more bearish than bullish, obviously with the gap up recapture on Friday. Maybe a little bit more optimistic. So higher lows over 400, trade back in the upward direction, look below and fail, and the target ultimately would be these swing highs in the daily 50 SMA at 413.25. Here it is on the hourly time frame chart to try to make a little bit more sense of this, right? Seems reasonable that a breakdown on Monday or just early on in the week, any opens underneath 404.90, 404.75, easily could retrace into that 400 when we get there, thinking about the reversal and what we just described on the daily to target up here at 413.25. If we are just consolidating in this zone, fine, let it do its thing, and this is the next trade, continuing to walk that up respectfully and really make sure that our risk reward is dialed in. Next up, we've got Google trying to resolve the earnings gap up, so clearly you're building out a balance range here. One of the most interesting things I find about Google is that on Friday, the volatility took you to a new lower low relative to the low of the Thursday session and even the Wednesday end of day breakdown here. So the fact that this did not see follow through underneath to continue closing the gap does strike me as a bullish takeaway. If we can look for any long entries at or near 166.75, looking for the rotation here to the earnings gap up low, and then beyond that, it would be to the opening print of the earnings session up there at 174.50. So if this is ultimately the base, looking for longs here, the idea would be initially risk reward makes sense here. If you can monitor for continuation, obviously it balloons, right? Any consolidation in this range, so if it breaks back down underneath, neutral. If we break down under here, there's the possibility that you could trade this short into 159.50, but on the daily time frame chart, remember, these are new all-time highs. Google's very bullish here. I'd be thinking about the opportunity for a not full gap fill reversal, but testing previous structure and finding buyers at 159.50. Next up, we've got Nancy. What's going on with Amazon earnings on Thursday after the close? Sorry, no, this one was on Tuesday after the close. My apologies there. But anyway, still dealing with the gap up from the jobs report on Friday. Any consolidation up here, again, we're just a hop skipping away from the all-time high. So hop skipping a jump away from the all-time high. Be my guest if you want to get chopped around. Again, these things, very, very lackluster days on Friday. So consolidation in here is bullish. It's over sort of the absolute terror zone, which I would describe as this box right here. Be my guest if you want to trade this thing. If it's underneath 182.75, I'm not interested in this zone here. I'm willing to trade for like higher consolidation, break all-time highs. If we pull back, open-minded to trying to find buyers off of this area here. It's inside of the FOMC volatility, but I'd be willing to give it a stab just based on highs, equal highs, equal highs, equal highs on Thursday as well. So I'd be willing to try it there, but underneath 182.75, not really interested in this box. Be my guest if you want to take a stab. Next up, NVIDIA. This one's also got a pretty interesting and volatile move around a pretty key inflection point, 841.50. So great higher high on the Friday session. That's worth respecting. Here we go to the daily time frame chart. Break underneath, lower high started to present itself, no follow through to the downside. Recapture, sloppy through the level, and now finally higher. So trying to navigate some of the volatility, I think that we want to remain grounded on the higher time frame daily and just say as a blanket statement, if we're over this line in the sand at 841.50, it's got to be a little bit more bullish than bearish, possibly rotating back up to these equal highs. Earnings are much further out on this one, end of May, so it's not a concern just yet. Gap fill reversal, constructive for a move towards the top of the range. Consolidation up here, breakouts over these equal highs, constructive to the top of the range at 922. Here it is on the hourly time frame. You'll notice if we pull back and get support over this area, the risk reward wants to be set like this, trading into that high we just talked about, 901.50. Beyond that, so say it's consolidation, say you can't pick it up here, and it's a break higher low there. It's the same concept. This is the trade that you're ultimately looking for. If it's going to be bearish, if you're looking to trade the pullback, I don't know that I would be a short seller looking for the pullback to trade short at least into the gap close at 860. However, under the gap with a lower high, you could at least maybe pull off something that does this as a scalp intraday. Wouldn't overstay my welcome at the weekly line in the sand, daily line in the sand that we were just describing. Here's AMDizzle. Speaking of semiconductors, what do we see post earnings? Pretty sloppy here. Actually, let's zoom back out to the daily so we can just understand this as a head and shoulders on the daily chart. So highs, lower highs, lower highs, lower highs. This gap down obviously offers a lower high, even on the gap fill reversal, right? So not out of the woods here, out of AMD, stronger daily downtrend compared to NVIDIA, as an example. If we are going to move higher, I think that there's at least a trade that could test the gap overhead into the early stages this week. Look at the Friday support over this sort of volatility from earnings, the FOMC volatility, the whole 9 yards. The fact that we supported over 148.50 is somewhat optimistic for trying to navigate something that does this. Risk reward wants to look something like that. Ultimately, with managing expectations, the gap doesn't have to close all in one fell swoop, but that's ultimately the target that we were aiming for. If it's going to be a breakdown, this is a lower high I would take every single time, noting that the daily trend is firmly down, right? So underneath 148.15 with a lower high, great, there's the trade. And that's what you're looking for in the downward direction. Metaverse, what's going on with Zuckerberg's Fantasyland? Keep it simple, stupid. Any consolidation in here is bullish over the top of the earnings gap down. Then you're looking for the continued gap close overhead over this 453.50 as a possible idea. The breakout is reasonable. This is all gap territory above, right? So that is Metaverse, only looking for shorts on a clear lower high underneath 443.25. A failure of this breakout from the earnings range would be somewhat concerning. So that lower high may be worth a stab, but even at that, I would tend to think that Meta is an even better short. Like, put your patience hat on and say, not really convinced about getting chopped up in the range, and more so, the lower high underneath 429.50 is more attractive. Tesla is up next. Speaking of Mr. Musk and his not so fantasy land, I mean, he's just living in his world, I suppose. This is not one of the things that I think is driving some of the volatility in the XLY as I gather my thoughts here. This is not ideal. It's not picture perfect, but it's also not awful, which is one of the reasons why I think that XLY wants to resolve that 177.75 area with a little bit more confidence. If Tesla can show us the way, if Amazon can get out of its own way and avoid that choppy, sloppy box that we were just describing, I mean, this is like, okay, great, XLY probably holds the 177.75. So Tesla as a major component, I would be very neutral through this area right here. Ideally, the gap up should have resolved for something that did this if buyers were truly going to remain like stellar, game on, totally bulls on parade. Obviously, it didn't happen on the Wednesday, Thursday, Friday session. The consolidation is actually underneath that 184. So open-minded to this possibility here. Previous resistance may act as support, but it's got to be more neutral. If you can clear this 184, definitely a bit better for the broad market as a whole. If it continues to drift, you're probably dealing with maybe the opportunity of a weekly inverted head and shoulders, but obviously into this upcoming week's worth of trade, it's bearish pressure intra-week. Netflix, last but certainly not least, probably least at this point, it's just unbelievable. Look at the structure on Friday, right? It broke the top of the range and just straight shot right to the top. So, hey, if you're willing to take a tight risk reward setup out of Netflix, it's moving, it's volatile, it's moving from point A to point B over and over and over again. So take a stab if you'd like, but the volatility is making it a little bit hard to actually rely on it pattern-wise. If we can move into this gap overhead, it's at least worth considering the opportunity for it to close. I mean, clearly, it has a propensity to move these days. You can see all of these round trips that it's been making. So if you're over 579, looking for the closure at 605.25, daily 50 SMA as a contender, you don't have to be the first one in the door. You could wait for a higher low above. It really doesn't look like it wants to give you a higher low above. It looks like it wants to make that move and have that move stick. But it could also, on the same side or the opposite side of the same coin, could easily do something like this and just retrace to the downside. So Netflix, it's not very trustworthy, but if you could set up the tight risk reward, if you know yourself as a trader, if you can respect a stop that's directly right here, it's probably worth taking. Say you want to take the short side, that's fine. If you can respect yourself as a trader and put a stop right here, and if you could take this as ultimately the range you're trying to navigate, then fantastic. But as of right now, little bit volatile in terms of respecting the actual patterns that are in force. All right, here we go. 3 trade ideas and you're on your way. TXN, Texas Instruments, is on the chopping block first. And notice that after the earnings gap up, we're getting this bullish consolidation. We're not closing the gap all the way. If we can take out all of these equal highs, the balance highs, we're looking to close the gap from a previous earnings cycle overhead. The break is over 179.75 to get into the gap at 181.10 and close at 184.85. If we're just chopping around in this range, there is no trade. Let's move along to the next idea. We've got got MRNA, of course, Moderna. What's going on over here? A beautiful bullish 3-bar play after breaking out from a balance range. So here's your aggressive ignition bar. Earnings obviously have something to do with that. There's your inside bar on Friday. If we're going to get follow through over 126.50, looking to target this area here at 131.50. Anything beyond that, we have 141. If there is a more aggressive pullback, that's fine. Let it go underneath 122.75, looking for the retest higher low entry here at 113.75. So MRNA is a top watch for either of these setups, right? Either bullish 3-bar play breakout or some sort of pullback to get the higher low at this zone on the retest of 113.75 once again. Next up, we've got MA, and this is the final trade idea for today's episode 3, and then you're done. We've got a hammer candle that looks underneath the previous 2 bars lows and close near the highs of this 3-bar range. Obviously, earnings gap down gives us some of this bearish consolidation. If there is going to be a counter trend move, we're looking for a move over the hammer high from Friday at 445 to retest 453.50, the breakdown point from here. Here it is on the hourly time frame chart. Notice the undercut. So this is really the premise of the trade, right? Here's your bearish momentum. We know that we have an earnings gap down. We know that we're in a downtrend, right? So to undercut a low and make a lower low and not find continuation and not find a lower high underneath, really this area right here on the hourly chart, to close back near the highs of the same day session at 445, open-minded to squeezing out some of the shorts here over 445 to target the origin of the breakdown at 453.50. That's what I've got for you in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live up in the Penthouse Suites on Monday morning at 8 o'clock. 8 o'clock is the new start time of the pre-market show. A lot of the folks up there in the studio really enjoyed that, so we will do it again this week. I hope to see you there, and with that said, I wish you a green trading week.